Hi, fellow investors. This is Sam Wadia for stocktipoftheweek.com. The tip this week is a portfolio for Eurozone markets, which is basically a portfolio that trades in the currency euro. It was quite simple in terms of selection of the stocks. The stocks are selected based on quantitative value investing principles. So the criteria are as follows. The market cap is over 100 million euro. The price earnings ratio is below 11. The 5-year average return on equity is over 10%. The diluted earnings per share 5-year average growth per year is over 3%. The price to book value is less than 2. The debts to capital is less than 50%. The price itself or per share is greater than 1 euro. The net margin 5-year average is at least 5%, and the currency trading is euro, of course. The sales 5-year average growth rate is over 3%. And here we see the way these companies, the number of companies out there have lined up. So starting with 745,000 companies, all the way down to just 10 companies that finally match each of the above criteria. I'm going to put a link to this spreadsheet below in the video itself. Now let's go over to the results. The results are as follows. We have a Dutch company called Boskalis Westminster, which is a building and construction firm. We have the Münchner Reuchwer AG, which is based in Munich in Germany. We have Score SE based in Paris, France. We have Michelin based in Clermont-Ferrand in France. Audi based in Germany. Danieli & Co. based in Batrio, Italy. Portucel based in Setúbal, Portugal. Ackermans and Van Haren based in Antwerp, Belgium. Socfinaf based in Luxembourg, and Parisien Chauffage Urbain based in Paris, France. These companies are of different industries as well, from building and construction to reinsurance to paper products, forestry, water, etc. And this spreadsheet, again, the link is mentioned below, has various criteria, various indicators about each company. So for example, here is the price to book value ratio of each of these companies. You have the 5-year net margin average of 5 years for each of these companies, the market capitalization, debt to capital, return on equity, 5-year average. And what you might notice is that all of these companies, because of the strict criteria that we used, are sound, profitable, growing companies, growing firms, which are currently trading at quite a reasonable price based on their potential growth rate, which also is mentioned here, sustainable growth rate, as well as their valuations. Now, sustainable growth rate, a small note on that, it is only reflective of the current year's growth based on their retention ratio and return on equity. That is the formula, and it's only based on the current year, so just bear that in mind. But many of the other ratios here are quite long-term in nature. Many of them are 5-year averages to give an indication of how the firm has been doing, not just over the last 1 year or currently, but also the 5-year averages. Of course, when we talk about valuations like price to book, price to cash flow, etc., price earnings ratio, the debt to capital, these are of current. So there's no question of having a 5-year average, because one is going to buy the company based on the current price and at the current levels of debt or leverage or gearing that has. So hopefully these 10 companies can make you a lot of money. The portfolio is geared to help you at least triple your investment in 10 years, could be even much sooner, as little as doubling in just 5 years and perhaps quadrupling in 10 years. So this is a portfolio for you to look up, to research, study each company, and if it meets your criteria of investment as well as understanding, you can buy one or all of these companies for your portfolio. Thank you very much, and I will talk to you next week.